Welcome back to our channel, where we make finance easy for everyone. Today, we're diving deep into the world of dividend tax, what it is, how it's calculated, and its impact on your investments. So, let's start with the basics. What are dividends and why do companies pay them? Dividends are a portion of a company's earnings paid out to shareholders. Companies distribute dividends to share their profits and to incentivize investors. Now, let's move on to dividend tax. Dividend tax is a tax imposed by the government on the dividends received by shareholders. It's important to know that dividends can be taxed in different ways depending on the country and the tax jurisdiction. In the United States, for example, there are two types of dividends: qualified and non-qualified dividends. Qualified dividends are taxed at a lower rate, similar to long-term capital gains, while non-qualified dividends are taxed at the ordinary income tax rates. Here's an example. Suppose you receive $1,000 in dividends. If these are qualified dividends and you're in the 15% tax bracket for long-term capital gains, you would pay $150 in taxes. If these dividends are non-qualified and you're in the 22% tax bracket for ordinary income, you would pay $220 in taxes. Different countries have their own rules and tax rates when it comes to dividends. For example, in the United Kingdom, dividends are taxed at progressive rates based on income bands, while in Canada, dividends have a favorable tax treatment due to the dividend tax credit. A common question is, how do I report dividend income on my tax return? In the US, you will receive a Form 1099 DIV from any institution where you have dividend-paying investments. This form details the amount of dividends you received and must be included when you file your taxes. To minimize the impact of dividend taxes, you might consider tax-advantaged accounts like IRAs or 401(k)s. Investments held in these accounts can grow tax-deferred, and in the case of Roth IRAs, withdrawals are tax-free if certain conditions are met. Let's address some common questions. First, do I have to pay state taxes on dividends? The answer is, it depends on the state. Some states, like Florida and Texas, do not have a state income tax, while others do. Here's another question. Can foreign dividends be taxed in the U.S.? Yes. If you're a U.S. taxpayer, you must report foreign dividends on your tax return. However, you may be eligible for a foreign tax credit, which reduces your U.S. tax liability. Let's recap with a quick summary. Dividends are a way for companies to share their profits with shareholders, but they come with tax implications. In the U.S., dividends can be classified as qualified or non-qualified, each with different tax rates. Internationally, tax treatments vary by country. That's it for today's video. We hope you have a better understanding of dividend tax and its impact on your investments. If you have any questions, drop them in the comments below. Don't forget to like and subscribe for more finance tutorials.